Hi folks, David Waring here again with InformedTrades.com. In today's video, I'm pleased to announce a new series on trading the economic crisis by Informed Trades community member, blogger, and partner, Simit Patel. In today's video, Simit's going to give us a simple explanation of how he feels we got to where we are today. Then, once we have this understanding, in future videos, Simit's going to explain where he feels we may be headed in the future and how traders who agree can position themselves to profit under that scenario. So let's get started.
Okay, the first thing that we need to understand when looking at this crisis is how money comes into existence. And money comes into existence when banks make loans. So really all money is loaned or lent into existence, and money comes out of debt. Once we understand this point, we can understand that if there's a lot of money in an economy, there's a lot of debt in an economy. And if you look at this chart that's on the screen now, it shows the level of consumer debt outstanding from the beginning of 2002 up until the middle of 2008, and we can see it steadily rising. And if you look at, or if you think about what happened in the U.S. economy during this time, we saw the housing bubble, and we saw prices rise significantly. We saw the gas price, or the price of filling up a gallon of gas at the gas pump, rise significantly over this time as well. And that's really a sign of the money-debt relationship. Whenever there's, bubbles in an economy or rising prices, that means there's a lot of money in the economy. And under our current system, the only way there can really be a lot of money in an economy is if there's a lot of debt in the economy. Okay, so how did all this borrowing and debt come about? Well, there are two things to bear in mind. One is the Federal Reserve, which is a government agency that works to target interest rates, had a policy of keeping interest rates low. Low interest rates means it's pretty cheap to borrow money. You can borrow it, and the amount you have to pay back is not really that much if interest rates are set low. So this sort of encouraged borrowing, and that sort of fueled an expansion of the money supply and the bubbles in that sense. In terms of how this money got put into the housing market, or channeled in the housing market, there was legislation passed that sort of created tax incentives to buy houses, as well as things like the Community Reinvestment Act, which helped people who weren't really qualified for loans get houses. Now, the other thing to remember about the housing crisis that really enabled this crisis to become larger and spread into pretty much all aspects of the economy is that the loans that banks made to let people buy homes were then packaged as assets and sold to investors. And this is referred to as the securitization of loans. So when you hear the term securitization, that means, or what's being referred to there is the banks taking those loans, selling them to investors, and investors would buy them and say, under the rationale that, we'll get the principal back and we'll get interest from the home buyers as well, so this is really an investment for us. And then a whole finance industry sort of grew around the securitization of loans. And then there would be insurance products sold on those loans. So if the loan defaults, then you get an insurance payout of this. And sort of all these financial products were born out of the securitization of housing loans. Now this is then in 2008 we started to see the problems really arise out of the system. Basically, a lot of bad loans were made, and the home buyers were not able to make the payments. The result of this was that the finance industry that was built on securitized loans started collapsing. So the investors who bought those securitized loans were not getting payments. The insurance products that were paying out in the event of loan defaults had to pay out too much, and they were failing as well. So really, we're starting to see this whole system collapse. And on top of this, the banks no longer have anyone credible that they can lend to. There are no more. They can't find credible consumers of debt that they can give loans to. And this is sort of ties into a concept known as peak credit. So there's sort of a limit as to how much debt that consumers can take on. And once you sort of reach that limit, you're going to run into issues, and the supply of debt is going to need to come down because people are going to need to focus on paying off their loans. And that's sort of where we're at now. Now, the government approach to this crisis has been to intervene and to give bailouts. And basically what they're doing is they're giving money to banks and they're giving it to investors who bought the loans. The idea is they're trying to repair or restart this lending process because they think if the banks can be lending again and if the finance industry can continue, the money can circulate and people will be employed and there will be production that way. Businesses will sort of get going again. Now, how is the U.S. government getting money to pay for these bailouts? Well, basically they're borrowing it, and they're borrowing it from foreign countries. China, in particular, is a key source of borrowing that to the U.S. government, lending money to the U.S. government to finance these bailouts. It's important to note that the U.S. economy under this whole system is still being financed by debt, or there is still the whole money coming out of debt issue that we talked about earlier in this video. Banks are no longer or have cut back on lending to consumers, and so money isn't being created that way. But money is coming into the U.S. economy when the U.S. government itself goes into debt. So we still have the money coming out of debt relationship. Okay, but this economic crisis has sort of grown, and as the bailout packages continue, the U.S. government is having trouble borrowing money. And recently, in March of 2009, we saw the U.S. government start to print money. Now, the danger of just printing money out of thin air is that it will devalue the currency that is already in circulation. And this can happen in two ways. One, the U.S. government just prints a really large amount of money and sort of devalues the money in circulation that way. But the other issue is that people can see the U.S. government printing money and they might run from the U.S. dollar. They might say to themselves, oh, the U.S. government's printing a lot of money. The dollar does not look stable. I don't want anything to do with dollars. I'm going to sell my dollar-denominated assets. So there can be in addition to an increase in supply caused by printing money, there can be a demand collapse. And that can really devalue a currency and create a lot of problems that way. The other thing to understand about in terms of from a macroeconomic picture what's going on now is that people who have dollars and who have saved their dollars, the value of those dollars is being diminished. So the value of their savings is being diminished, and essentially the value of their savings is being transferred to whoever's getting the new dollars that are created. So the investors, the companies that are getting bailouts are being the recipients of this wealth, whereas the people who have saved are losing this wealth. So really this is a form of taxation, or it's a way of government not really creating wealth, but more so redirecting wealth from people who have saved to the banks and to the investors that are receiving this money. Okay, so now that we sort of have an understanding of what's going on in the crisis and where we're at this point, what are some solutions? Okay, the first solution would be to fix monetary policy. Basically, if we have a system where all money comes out of debt, it's not really surprising that there's trouble paying off debts. If the only way I can get money is to take a loan, for instance, I have to pay back the loan and the principal. But if all money comes out of debt, that makes it hard to pay that off. So really, there's a system where money comes out of debt is going to run into the peak credit problem, where eventually it can last for a while, but eventually it's going to run into the issue of there being trouble of paying off debts. And then at that point, then you're going to start to see the recession and sort of the collapse and the foreclosures, or the defaults on debt because of the difficulty of paying off debts in a system where all money comes out of debt. The other critical part to understanding this crisis is, what really enabled the collapse of the housing market to spread into really all aspects of the economy was the securitization of loans that we talked about earlier. So, previously, there was something known as the Glass-Steagall Act, which kept investment banks and commercial banks separate. Commercial banks are the banks that make loans, that deal with consumers, that you sort of have your checking account with. And then there are investment banks that are more about fueling investments and taking on finance risk and speculation and financial products and things like that. The Glass-Steagall Act was discarded in the late 90s, and that enabled a merger of commercial banks and investment banks. And really, that's what enabled all the finance products to be created, built around the housing market. And that's what really, once the housing market started collapsing, that finance industry started collapsing as well. And that's how what would have been a smaller problem, just something confined to just the housing market, has really blossomed into a full-blown sort of economic crisis. So basically, the two lessons that we can learn from this economic crisis, or the two ways of solving this economic crisis and making sure it doesn't happen again, is to fix monetary policy so that we have a system where all money does not need to come out of debt, as well as separating commercial banks and investment banks so that lending to consumers does not necessarily need to, especially in a specific niche or area of the economy, does not lead to a cascade effect that can bring down the whole economy. That's about it in terms of our explanation of the economic crisis. If you're looking for more information, as well as information on how you can trade this economic crisis and preserve your wealth in these times, visit us at informedtrades.com. Thanks a lot and take care.